Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
When you look at the Tesla story, autonomous FSD, I could argue it's one of the best AI plays in the market when you look at the next 2, 3, 4 years. This is just the start of the next chapter, the next book, as Musk calls it, in the Tesla growth story. I think it's one of the best disruptive names in the world.
It doesn't appear that the technology in this AI story is approaching a level where it's going to stall. It looks like it's still morphing into other things.
The only thing sustaining current economic growth is a wealth effect from the bull market and consumer spending. The asymmetries of risk are that the economy can do much worse than consensus far more easily than it can do much better than consensus.
1 hour to go until the market close. So let's take a look at the major averages right now. We are losing a little bit of steam today after the rally that we've been seeing in recent days. Right now, the Dow off by nearly 100 points. It's off by about 0.25%. The S&P 500, after 4 consecutive record closes, is not on track to repeat that feat today, down about 0.1% or so. The Nasdaq, though, maybe. We've got right now, it's very little change. So we'll see where it trends in the last hour of trading. And by the way, the Nasdaq return over the past 5 days looking like here better than 3%. Looking over at some of the components of the Nasdaq, you know, it's been so interesting. We keep talking about this broadening of the market. We talked to our Josh Schaefer yesterday that a lot of Wall Street strategists are calling for that broadening in the second half of the year. But we have seen really some of the large cap tech continue to lead some of the gains that we have been watching. Here's the weekly look here. You look at an NVIDIA up 9.2%, Apple up nearly 8%, Microsoft gaining, and you see what's been going on there. Another name I wanted to call out here is Netflix, up about 2.75% today and trading at looks like maybe on track for a record close in today's session. We're going to keep an eye on that to see if it makes it there. The year-to-date return for Netflix, some 38%. We also continue to watch the sort of market cap race, if you will, here for many of these companies. Not seeing the market cap here come up on this one. See if it will, if we switch it around a little bit. Nope, it's not coming up. But anyway, you see what these guys have been doing on a daily basis here. There's the market cap. So we've got Microsoft back in the top position, Apple now in number 2, NVIDIA in number 3, but we continue to have that sort of neck and neck race for market cap between those tech giants, Josh.
All right, Julie. Stocks are fighting for gains today as consumer sentiment tumbling in June. This comes as the S&P 500 and Nasdaq have each nailed record closes this week. For more on the latest market moves, let's welcome in Sam Stovall, CFRA Research Chief Investment Strategist. Sam, it is always good to have you on the show. So as Julie was pointing out, maybe we're taking a bit of a pause here, Sam. But of course, we've had a strong run. What do you make of this market, Sam? Just where we are and where you think we're headed.
Hey, Josh, good to talk to you again. Yeah, I think at least in the near term, we're probably headed a little bit higher. But I am getting increasingly concerned that we have to endure another decline of 5% or more before the year is out. I point to history for making that statement. This was the 11th best first quarter return since World War II. And of the top 15, 14 of them had declines of 5% or more. And then if that decline was actually less than 10%, we had a repeat. And the average decline was about 12.5%. The good news, the silver lining, is that each one of these 15 years posted full year gains, with the average being above 20%.
So that seems to bode well, Sam. But in the meantime, when you talk about the possibility of that pullback, what are your main contenders for what could trigger it?
Well, I guess the real problem is that the market tends to get tripped up by unanticipated events, and unanticipated events are hard to anticipate. But I would tend to say that if we end up just moving too quickly, right now the S&P 500 is trading 1 standard deviation above the average difference between its 200-day moving average and the index itself. So I just feel that if we get too far above, we're time to have some sort of resetting of the dials, digestion. If we start to see other economic indicators that point to an economic slowdown that causes investors to worry that maybe we are headed for recession rather than simply a soft landing. Let's face it, today's consumer confidence was something that was not anticipated. But at the same time, I still feel that these kind of resettings of the dial are healthy for the market.
Also, Sam, so you're talking some technicals there. Also interested, though, Sam, just to get your take on valuation here for the market. At these levels, how's it looking?
Looking pretty pricey. As the S&P 500 is trading at a 30% premium to its 20-year average PE. We're also looking at tech that's trading at about a multiple of 30, which is looking sort of like a very firm ceiling for that group, also trading at a hefty premium to its longer-term relative PE. Those groups that are actually attractively valued from a relative PE discount perspective, not surprisingly, mid caps, small caps, energy stocks, as well as utilities.
And let's talk about the other side of that coin, right? In big cap tech, as I talked about earlier, they continue to be dominating returns here. When you look at the major averages, accounting for a lot of the gains we've been seeing. Where do we go from here on that front? I mean, these guys are still setting records.
Oh, they sure are. Technology was the best performing group on a year-to-date basis. Also, just in the past week, technology was up almost 6%, while the S&P was up less than 2%. And technology was the only outperforming sector. So I guess another worry could be how long can this jumbo jet fly on only one engine? But my feeling is that historically, in election years, when you do have the top three performing sectors midway through that year, they tend on average to be outperformers for the second half as well.
And Sam, just one other sector I want to kind of dig deeper with you on is utilities, because we've had some smart strategists come on the show and really pound the table on that one, saying it's a smart way for investors to kind of play offense and defense at the same time. But you're actually underweight that sector. How come, Sam?
Well, because what we look at is not just the momentum of the group, but also the percentage of stocks in the category that have buy and strong buy recommendations. And our analysts basically are pointing to the fact that only 3 of the 31 companies in the S&P 500 utilities sector index are really AI related and are posting above average returns. Take out those stocks and the sector would be underperforming. So I think you do have to be fairly selective. Yes, there will be increased power needs for the data centers, et cetera. But I think you have to be very selective as to which stocks to go for.
Sam, one of the things that we've noticed as of late among some of the large cap tech, but just more broadly, are new stock splits being announced. And I don't think the numbers necessarily on an absolute basis are going up, but we've got a lot of high profile companies. You know, we had NVIDIA, we had Broadcom announcing them. Does that say anything about the sort of general vibe of the market at all?
I think it does. I think it indicates that company management is feeling more optimistic about the future. And so they are willing, in a sense, to make their share prices more accessible to a greater number of investors. Institutional investors focus more on the dollar value, but retail investors look to the price of the underlying stock. Remember, I go back a long way, and it used to be that a stock wanted to split if it got between $40 and $80 a share to make it more appealing and affordable for investors, because back in the 60s, 70s, et cetera, prior to commission-free trading, it was a lot less expensive to buy a round lot or multiple of 100 than it was an odd lot. Also now today, however, with commission-free trading, with the fractional shares, basically it's not much of a concern, but it is more of a psychological tailwind for that company.
Sam, shifting gears a bit here, I'm also interested to get your take on politics and just sort of the kind of political uncertainty we're now seeing really kind of on both sides of the Atlantic, Sam. Of course, in Europe, you saw what happened there. Things seem to be on the move, maybe a real shift to the right there. Of course, here we have the election coming up. How, as a market strategist, Sam, are you trying to think through all that?
Well, that's a good point. I mean, we do have our Washington analysis arm, which monitors all of the bills going through Congress, but also monitors the polls to see which candidates are ahead. And right now, the thought is that if the election were today, Trump would be the victor, and the U.S. would too also be shifting more toward the right. What it reminds me of are years like 68, like 1980, like 1948, when you actually had third-party candidates involved. And basically with Robert Kennedy Jr. now in the race, along with Trump, Biden, where they are split evenly right now. In many ways, it's anyone's guess. Historically, it used to be that the market's return from July 31 through October 31 was a very good indicator. An upward move pointed to a re-election, a downward move pointed to a replacement. But with asterisks, usually the third parties can be disruptors.
That is really interesting, Sam. We will keep an eye on that return with the asterisk in mind. Good to see you. Thanks so much and have a great weekend.
Thanks, you too.
Well, let's check in on one of the top trending tickers on the Yahoo Finance homepage now. It's another ticker being fueled by AI. We're talking about Adobe. Shares have been soaring today. David Wadhwani, the president of the company's digital media business, says we're excited about the accelerating pace of innovation across the digital media business and pleased with the adoption of AI functionality. That has something that propelled the numbers higher in the quarter and also propelled the forecast. And Josh, as we discussed yesterday a little bit, it is not something that investors had taken for granted.
Mm-hmm. Yeah, I mean, it was such an interesting earnings print because there had been these real worries about, and really two big worries. One, there was the macro and just the choppiness we're seeing in other software names, but the guidance they offered seemed to put that worry to rest, at least for now. And then there have been these concerns about Gen AI competition too, but I think people looked at this print and thought, you know what, it looks like, at least based on this report, they're finding real traction with their AI features here.
Yeah, and the stock gain, by the way, that is on a single day basis, the biggest gain in 4 years. So really the stock jumping here, although it has been down this year. It was up big last year, then has fallen this year because of some of these concerns around some of the issues that we're talking about. And really what the company emphasized in its call and the forecast is that it expects things to accelerate with that annual recurring revenue in digital media through the course of the year.
Yeah, the team at Jefferies, led by the great Brent Till, telling the clients today there was little to poke at in these results, that Adobe appears to be finally reaping the fruits of investing in AI and digital content creation and marketing tools just when content demand is exploding. Seems like at least a few people agree with them today.
Yeah, it definitely looks that way. All right, we're just getting started here on market domination. Coming up, Elon Musk has won the shareholder battle to keep his record-breaking pay. So what now? What's next for Tesla and its CEO? We'll discuss on the other side. Plus, it's the latest edition of our series, Goodbye or Goodbye. We'll take a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stay tuned, more market domination on the other side. The votes are in, and Tesla shareholders approving CEO Elon Musk's controversial $56 billion pay package. Musk taking the stage after the results and offering some characteristically optimistic goals for the EV maker.
It's within the realm of possibility for Tesla to achieve a valuation 10 times that of the most valuable company today. And if you just plot the points on the curve of how well autonomy is progressing and just believe the curve, it's headed towards unsupervised full self-driving very quickly at an exponential pace. It actually gets way crazier when you think about the Optimus robot, which is really a humanoid robot that is intended to be able to do anything you want it to do.
Joining us now is Kevin Paffrath, financial analyst and YouTuber Meet Kevin. Kevin, let me take it off here, right? We're going to have self-driving cars, robo-taxis, where we let Tesla navigate our cars around. We're going to have a robot that does everything for us, I guess, and the value of Tesla's going to be some, whatever trillions of dollars here. What do you think?
Well, I think there's a lot of hope built into that, but let's say, look, the shareholder vote now behind us is great news. It's a big negative catalyst away for Tesla, but you're right. Elon has grand visions that you won't have to drive anymore, which frankly, cars driving themselves in the long term, probably going to be a lot safer for the entire world. They already are today on FSD, substantially safer. So I think it's a great thing. And we've seen a lot of progress in full self-driving. I question the exponential progress that Elon is talking about, this idea that, FSD is growing exponentially. It's growing, but what we know with artificial intelligence, which Jensen Huang showed us in one of their artificial intelligence presentations, was that the costs for artificial intelligence go up exponentially, but progress actually more S-curves and then peters out, so you get less progress with more costs. And so going forward, yeah, Elon's right. We are going towards an autonomous future, and it's so great to see shareholders reaffirm their trust in Elon. I just don't think it's going to happen as fast as he's suggesting, and I don't think it necessarily is going to be as large in the long term, but that's okay. We can be bullish on the stock in the next 2 to 4 years, as Tesla still has probably the best moat in full self-driving that exists. It's not as big as it used to be. I'd put it at about 18 to 24 months ahead of some of the competitors, what we're seeing out of BYD in China, Xpeng Motors, but we're definitely still ahead.
And Kevin, you did mention that pay package and it did get approved. And so I'm just curious, Kevin, is that what you expected? And as a shareholder, is that what you supported, Kevin?
Yeah, it is. So I did this little tax loss harvesting event for my fund, PP, the Pricing Power ETF, where we sold in mid-March and then bought back in at roughly the same price in mid-April, but we missed the vote deadline by 1 day. That said, I did make public that I was in favor of the vote passing and that I would vote for it if I could. Now, with this vote out of the way,
can I ask you, Kevin, how come?
Let
me just get your take. Why, Kevin? Why did you support it?
Oh, absolutely. Well, so first of all, the deal was made in 2018, and it was very public. This was like a YOLO call option for Elon to go for this. Frankly, if that same deal was made today at those prices then, everybody would look at that as a shareholder and go, well, at least 70% like we had then. Of course, we're going to support if you can move the market capitalization of this stock essentially exponentially. Of course, we're going to support paying for you. So receiving that and then being frustrated about Elon in the short term, I don't think is fair. I think it hits on an element of justice, but we could really go into sort of a different world there. I don't think justice was served by what the Delaware judge conducted. That said, long term, we've got to look at Tesla as, this is how I value it. I don't look at it as a $30 to $50 trillion humanoid Optimus, program. Look, that's great. That's wonderful, sort of icing on the cake as a financial advisor and running a fund. I can't price that in. So what I do is I look at data. I look at Q2 data bottoming. Early sales data indicates that Q2 is not going to be as bad as feared. I think it's because of the financing. They finally realized that offering people a lower monthly payment, just 0.99% APR in May, now they're at 1.99 in June, is a sign that People are payment sensitive, not necessarily price sensitive. And I think that's actually going to help skyrocket Tesla shares and form a bottom here in delivery numbers. And we already know that margins have bottomed. They're the only automotive company to have over 18% gross margins, excluding the Cybertruck, on vehicles, especially electric vehicles. Most companies lose money on these. So really what Elon's doing here is he's creating a bottoming process in the actual manufacturing of electric vehicles. At the same time, he's rehired back the charging team, which is great, most of them at least, and all of the other electric vehicle companies that I'm studying, Ford, GM, they're all scared. They're reducing their exposure to electric vehicles. Elon is creating a massive United States electric vehicle moat for Tesla and Tesla shareholders.
Kevin, if
that said,
one
last thing quickly.
Sure.
If China were able to sell EVs here, I would not own Tesla. So you are relying on the government to protect you a bit.
Well, and when you're looking at how this company is valued, though, I mean, just to compare it to Toyota, just to give one example here, you look at the market cap of Tesla versus a Toyota, there is a big gap here. Tesla, a bigger market cap. The gap has been bigger in the past. The revenue Toyota, though, is not quite 3 times, but close to 3 times. The margins, to your point, at Tesla on an automotive basis are higher. But, if you're just looking, we always call it an EV maker, but if you're just valuing it even if you're just valuing it as an EV maker, it doesn't seem to account for how the market is valuing it. It has to deliver on all this stuff. And it doesn't seem to, can it be in 2026 or 27 or 29 or whenever this stuff that he's promising is actually going to happen?
Well, I like to look at sort of what do I think Tesla is going to deliver versus what Elon promises, because I think there's a large split between those. Don't get me wrong, I appreciate the optimism in a CEO. I would expect that. And you're right, Toyota would have been a much better stock, frankly, to own for the last 3 years than Tesla. Tesla's just been on a straight downtrend, and it's very unfortunate. The difference between the two companies is growth. I value Tesla at a PEG ratio of 1.67, assuming we can get about 30% growth once we bottom out from here. Toyota's growing. In some years, it's projected to grow negatively, but more reasonably, it's growing somewhere between 5 to 6%, which is barely above the rate of inflation. So that's one of the reasons you see the valuation disparity. But it's also one of the reasons you've seen a lot more downside with Tesla, because we did have to go through a few negative growth periods. 24 is going to be the big one. Now, that said, here's how I think someone could hedge themselves. Obviously not personalized advice, but I think you can go short, and people get mad at me for saying this, but it's just a hedge. It's a macro hedge. You go short Bitcoin. You could use a fund like BITI. I'm not affiliated with them. It's a negative one. The reason for that is when risk assets sell off, Tesla goes down. Look at what's happening today. The French sovereign debt crisis, you've got risk assets selling off. When risk assets sell off, Bitcoin goes down as well. But look at NVIDIA, it's up. So you don't want to short the whole market for a hedge, because that's not going to work. You specifically want an offsetting risk hedge. And I think Bitcoin is the perfect way to hedge your Tesla position.
Interesting. That's not one I've heard before.
No.
Sorry.
Kevin, Kevin, thank you so much for joining us. We always appreciate the time. Have a good weekend.
Thank you. You as well.
Now let's check in on some more trending tickers. Starting with MicroStrategy, shares jumping. Company now seeing it's raising $500 million in a bond sale in an effort to buy more Bitcoin. So this one, Julie, let's keep it simple. Basically, they boost their convertible note offering by about 40%, and company says they're going to use the proceeds to, you guessed it, buy more Bitcoin. Of course, Michael Saylor, co-founder and chairman here, started buying Bitcoin in 2020 and has become certainly one of the better known Bitcoin bulls out there. And it is up about 600% since Mr. Saylor first started piling in here.
Yeah, and do you know MicroStrategy now owns about 1% of all of the Bitcoin that's ever been created, which is amazing. At the same time, we've got Gautam Chugani over at Bernstein initiating coverage of MicroStrategy, and he's positive on the stock, but not just positive on the stock. His price target is $2,890, which would be about 80% higher than it is right now. And it's so interesting. MicroStrategy is quite controversial, to be clear, right? There are folks who've shorted the stock. There are people who have criticized the premium at which it trades to Bitcoin. If you look at how MicroStrategy has done this year versus how Bitcoin has done this year, it's up a lot more. And it holds a heck of a lot of Bitcoin on its balance sheet because, as you see there, almost all of the cash it has is in Bitcoin, compared with other companies that you think of as being pro-Bitcoin, like a Tesla or a Block. All of this is something that Chogani likes and thinks that their leverage strategy is a good way for people to kind of get in on Bitcoin.
And by the way, you mentioned the team at Bernstein issuing coverage here. They gave you some Bitcoin targets as well. You see that in the note?
I
They
did.
revise up our Bitcoin price expectation. They're now look to 200,000, they say, cycle high by 2025. Led, they told their clients, by unprecedented Bitcoin demand via those shiny new ETFs
Right.
and Bitcoin supply being constrained.
What's interesting to me is one of Chogani's, the reasons he's bullish on MicroStrategy is he says investors are willing to pay a premium in view of scarcity of Bitcoin corporate investment vehicles. Now, there is that scarcity of corporate investment vehicles, but to your point, there is now no shortage of ETF investment vehicles. So the whole argument for a premium because of MicroStrategy being this rare leveraged way to play Bitcoin or rare even way to get access to Bitcoin without buying it directly, that has gone away a little bit.
Took a little bit of a hit, yeah.
Yeah, so we'll see if that keeps up, that premium continues to widen. Let's also talk about RH. It's in focus today after the furniture retailer reported a wider than expected first quarter loss here. The shares down the most in a single day, going back to March of 2020. And basically, the company has been on a big expansion, right? It's expanded into Europe. Although it at first expanded into some secondary markets in Europe, sort of as a test case, it's building itself up as this broader luxury brand, like a Ralph Lauren, for example. It's opened restaurants. It has these fancy new showrooms. And it seems like it's costing it a lot of money, and that then feeding through to the results.
And by the way, CEO Gary Friedman on the call, you hear him mincing no words on the Fed, saying, I think they're going to be, this was on the call with analysts, of course, I think they'll be behind the curve, he says, it relates to inflation. Says, I think they're going to be behind the curve as it relates to timing of when to cut those rates. So our view is probably a little bit more negative than it was a quarter ago. I think a quarter ago he told the street we were feeling a little bit more optimistic that there would be rate cuts and the housing market would begin to meaningfully move in a sustained manner.
Well, that would be in his interest, wouldn't it?
It
If
sure
they would cut rates sooner and get
Gary
to
not
it.
sounding happy.
Although he is also really trying to cater more to ultra luxury at this point. And you could argue that those folks are not as sensitive to changes in interest rates. So does that also say something about
If you want to
that
buy a
strategy?
nice leather
potentially?
couch, you're saying it's not as sensitive?
If you're buying, what is it, $5,000 couches and up, yeah. There was a $14,000 couch I saw cited in one article.
Yeah.
Yeah.
I bet it looked nice. I bet so.
I'm sure it did.
All right, moving on. Tempus AI making its Wall Street debut. Trading started today on the Nasdaq. The company pricing is offering at $37 per share. So this one was an interesting one. So it makes its debut. They're using AI to process medical data. They've actually been around for some time, Julie. They were actually founded in 2015. Described their business as creating intelligent diagnostics for precision medicine. In terms of the financials, posted revenue of $532 million in 2023. And that was up from $321 million the year earlier. It looks like they're still losing money. Net loss about roughly $200 million in 23. Of course, not unusual for a tech company to go public, posting losses, and investors will often look through that, especially if you have AI in the name.
Yeah, although it's
That
become
helps.
less typical, I feel like. You have more companies more at a more mature level coming public and maybe posting profit, but this not that case. It sounds interesting what they do. They connect your lab results to your personal clinical data to kind of analyze, I guess, using AI. So, we'll see how they continue to go. They did rise as much as 18% at one point during the day, but as we could see, they're up about 10.5%.
CEO Eric Lefkofsky, also, by the way, co-founder of Groupon. Little known fact.
Interesting.
Yeah.
Very different business.
I don't know what lessons he's applying, but he must be applying something.
Hopefully he'll come talk to us and we can
We'll
ask
see.
him.
So that's a formal invitation to Eric.
There you go.
All right, still to come, it's the latest edition of our series, Goodbye or Goodbye. We'll take a deeper dive into two stocks to help you make the best moves for your portfolio. Stay tuned. More market domination on the other side.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're taking a look at business strategies of two companies in the tech realm. I'm here with Threadneedle Ventures founder Ann Barry. Ann, good to see you. Thanks for being here. So let's get to your buy stock first of all here. And we are looking at Palo Alto Networks. And this company, it's up over the last year, although it's had a little bit of volatility, as we can see from this chart. Cybersecurity has been a really interesting space, and we've seen some sort of volatility within it as well. Let's talk about platformization. I even have trouble saying this word, platformization, which I started seeing a lot more in the discussions of companies like Palo Alto and CrowdStrike. What does this mean?
Yeah, it's a lot of syllables to say. Small businesses, enterprises want to buy their cybersecurity solutions from one place, from one company. Right now, historically, businesses have had to go out and put a hodgepodge of different pieces of the elements of cybersecurity together. And they're saying, you know what, it's really inefficient. It creates vulnerability. We want to go to one place. And Palo Alto has really been leaning into being a solutions provider, hitting on a lot of those different vertical solutions.
Well, that explained it better than any of the companies that I heard themselves discussing it. Palo Alto's also been winning big contracts from big companies.
Yeah. Big ones recently. United Healthcare was a big one that got announced. A big strategic relationship announced also recently, Julie, with IBM. And what Palo Alto is going to be doing is providing a lot of the cloud and cybersecurity solutions that IBM is going to its consulting clients and saying, look, this is the go-to place to come to. So that was a big one from a go-to-market perspective.
And then finally, also, there's the free cash flow that we are seeing at the company that it could potentially be growing.
Yes, I love this. You and I talked about this a lot. I'm a free cash flow girl. 37% free cash flow margin for Palo Alto Networks. That's right now. That's before they continue to see some of the efficiencies. They're very focused on cost. A lot of the young businesses, the startups, the growing companies I speak to, if they could pick their acquirer, they'd like to be bought by Palo Alto Networks, and these guys have got the cash and it's growing.
So you think if they're going out there to make acquisitions, it's going to be of technology, it's going to be of startups rather than a big sort of acquisition?
I think so. I think that actually if you look at value creation over time, finding homes, finding tuck-ins where you can really get synergies without the risk that comes from doing a big merger of equals or consuming a massive acquisition with a potential clash of cultures. I think Palo Alto is going to be able to get some chunky, some sizable acquisitions, but nothing that's too big to swallow.
And that way you add to the functionality of that big platform as well.
Filling in those gaps.
We like to talk about the risks potentially here. And, they're spending money, they're being aggressive. What are the sort of downsides of that?
Well, this one is one where you have to believe in execution. You've got to believe you've got leadership setting clear goals, holding their teams accountable, and making sure that they're super focused on how they're actually doing what they say they're going to do. It sounds simple, it's very hard to do in practice. In this case, Palo Alto has been going after a really bold, I think, strategy to get market share. They've been going to some big potential clients and saying, if you are using an existing alternative provider, we will onboard you and take you on for a couple of months for free so that you're not double spending, as long as that is an incentive for you to move over. That's pretty bold. It means a couple of losses on some of those accounts as they win them, but it's working at the moment. It has to continue for the share price to keep heading upwards and to the right.
All right, and before we head to your goodbye, the stock you don't like, do you hold Palo Alto?
I do hold Palo Alto, and I've been adding that share price you had at the beginning. When you've seen those dips, I've been going back in.
Oh, interesting. All right, let's get to the stock you're avoiding, and that is PayPal. And you're not alone in avoiding this one. The stock is down over the past year, but let's get to why you're avoiding it here. Well, Palo Alto has that bold strategy. You don't think PayPal has it.
Here's the thread. Both of them are execution plays. I'll come back to that. But this is also about PayPal. When you take a big step back, this is a business that touches 25% of global e-commerce. I look at that and say, this thing should be winning. It should be winning on data aggregation. It should be winning in AI applications. It should be winning in gaining share and cross-selling. This new CEO has now been in the seat about 9 months. I've been waiting to hear, here's the big, bold vision that we've got. Palo Alto Networks, crickets, haven't heard it yet.
Yeah, I mean, part of that, I guess, is a go-to-market strategy. Now, we've been talking a lot about go-to-market strategies with these enterprise players. Basically, what it means is a sales strategy.
Correct.
How do we get our product out there to more people and sell more stuff?
That's exactly right. And so what PayPal has been doing is moving the deck chairs a little bit. They've said that we're going to go after market verticals. We're going to stop selling on a product-by-product basis and selling on a solutions basis to the different user bases. But again, if it's not going behind a big strategy, what you're doing feels a little bit like tweaking around the edges, and I haven't seen really groundbreaking results coming out of these tactics so far.
Well, and to your point, PayPal is enormous. I mean, I can't tell you how many times I click on that. You've got check out using
Right,
PayPal.
exactly.
But if they don't do these other things, maybe that market share dominance will not last.
Well, I think that's right, Julie. And also, this is one where I've looked at the rise and rise of Stripe, for example. I've looked at the rise and rise of the BNPL players like Affirm, Afterpay, Klarna. And I look at that and I sort of want to tear my hair out because I'm like, where's PayPal? Right? They had the first mover advantage to be able to take what are products. What I've just said, Affirm, Afterpay, those were products. They didn't have to become enterprises. Had PayPal got its act together and gone after it, and it didn't. So I'm concerned about market share.
And then on the flip side, what could work for PayPal? I guess, to put it simply, is if they start doing all this stuff that you're talking about.
Well, exactly. So Alex Chris, again, I have deep respect for him. He got into the seat 4 months ago. He went on TV and he said, we're going to shock the world. Right, we've got this great start with this huge amount of penetration. We're going to shock the world. Well, I'm ready to be shocked. Let's see it.
Yeah, it still didn't. He then came out with I don't even remember what the announcement was. That's how
innovation. I don't really remember.
Right, exactly. That's the point.
There's a shrug. There's a bit of a shrug when it comes to some of the PayPal innovation, and I'm ready to be shocked, even if it's got risk. Right, I like the fact that Palo Alto Networks says risk to the strategy, but at least it's got one.
Yeah, they're taking that risk. Any position in PayPal one way or the other?
I sold out, so my money's been doing what I'm saying, Julie.
Okay. And good to see you. Thanks for coming
Thanks for having me.
And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes next week at 3:30 p.m. Eastern.
All right, let's get to our call of the day. Check out shares of Shopify. They are on the rise. This is coming after a new note from Evercore ISI, upgrading the name to Outperform from Inline. And this is Evercore's Mark Mahaney, of course, well-known, well-respected analyst who folks pay attention to. Mahaney does upgrade this one to Outperform. Price target 75, says there's been this pullback on this one, and the stock is down about 12% this year, and that offers Mahaney telling his clients an attractive entry point. Says valuation and estimates he thinks now sufficiently de-risked.
Yeah,
Julie.
and he's looking at the long term here when he's looking at this stock. He says there is a very resilient long thesis, and he talks about a couple of things that support it. He talks about the very large total addressable market, strong competitive position, up-market activity, and clear track record of successful product innovation. So he's got a lot of reasons he likes it. He was just sort of waiting, it sounds like, for this entry point with the stock. I mean, it's come back a little bit lately, as you can see from that chart, but also still is kind of weak year to date.
Yeah, and Mahaney not on an island here. I mean, most of the financial analysts covering this name do think it's a buy.
Yes, we'll see if it goes to that $75 price target or not.
There we go. Still to come, get out the sunscreen and pack those bags. We're talking all things travel, from cruises to airlines, next on Market Domination.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Shares of cruise lines hitting choppy water in today's trade. Viking Holdings, Royal Caribbean, Carnival Cruise Lines, and Norwegian, they all came under pressure after B of A analysts called out what they said was modest softening in ocean cruise prices during the month of June. So it was interesting here, Julie. I mean, the companies obviously had been reporting earnings results, and I thought, the kind of message, the takeaway was it was broadly positive. Yeah. I mean, there's still lots of talk about record bookings, for example, but here comes B of A, and their team gets to work, pull out their pencils, and then conclude that in June, there was indeed, they say, modestly softer pricing in ocean markets relative to early May. The analyst saying 40% of cruise itineraries had softer pricing compared with 33% in May. And you saw the stocks reacting to that.
I mean, on the flip side, if you dig into, it feels like, yes, there was a sell-off on this, but also maybe there were other reasons behind the sell-off. I mean, if you dig into this, and you can see from that chart, it's really volatile, according to their survey at least. If you look at the pricing that was negative in the past month, that 40% figure, you get 33% the month before that, 21%, 60%, 24%. It bounces around a lot. Yeah. And it seems like that the cruise lines are very reactive when it comes to pricing, dynamic pricing. That's something we've heard from them before that they do. So it's hard to know how seriously to take this. I mean, one interesting minor note from this is that they also did a survey of Viking pricing for the first time. Viking, the European riverboat operator that just came public, and they said there's less volatility in that market. I mean, there isn't as much competition, I don't think, in the river cruise market, so maybe that's part of the reason why, but it had flat pricing sequentially.
Also, just as that chart pointed out, I mean, some of these names have had some runs. Royal Caribbean's up more than 50% over the past 12 months.
Well, sticking with travel, Josh, airlines have a potential problem. Travel demand is projected to hit a record high this summer based on earnings forecasts, but the issue, ongoing problems at Boeing are hindering airlines' access to new planes and limiting potential for growth, potentially. We're looking at how to navigate the big picture with the Yahoo Finance Playbook. Joining us now, Peter McNally, Third Bridge Global Sector Lead for Industrials, Materials, and Energy, alongside George Ferguson, Bloomberg Intelligence Senior Analyst covering the aerospace, defense, and airline industries. Guys, it is great to see you. Thanks for being here. I think you guys have a little bit different views from each other on the capacity constraints that are out there. Peter, I want to start with you and how you see it for the industry there. What's the demand-supply matchup looking like right now?
Well, demand's been healthy. It's been growing for 4 years now. The problem is, airlines do want these new planes. They can't get them. They're keeping the ones that they do have in the air longer, for sure. But there's still some maintenance constraints, too, that need to go on, particularly around engines. So it is, capacity's growing. It's just not growing as fast as the airlines hope. And you've got, companies like United who've got very ambitious targets out to 2026 that they've had to temper that a bit. So, we'll see. It doesn't seem like Boeing's problems are going to be sorted anytime soon. And it's not like Airbus can go any faster than they already are.
And George, let's get you in as well. Maybe we'll start there with that same big picture question, George. Demand, supply, dynamics. How are you thinking about it?
Yeah, so we put a report out this week on this question because it's been overhanging the market here for, I think, for months now. There's definitely a lot of concern that there's not enough lift. We basically analyzed profitability for all the major airlines globally, and we looked at their EBITDA margins, which would be margins before you pay for any changes in your capital structure because debt maybe you took on during the pandemic or whatever. So we looked at EBITDA margins compared to last year, compared to 2019 and 2016, two of the best years in the last decade. And most airlines aren't achieving those margins. So I'd say there's record travel, and that's because the airlines are putting record schedules up into the air. But probably, thank God, they can't get all those airplanes because they crush margins even more. When will they slow down? I think when they start having losses, and they're not there yet. But when we look at profitability and return on invested capital measures, they are just not performing like they did last decade. There's too much capacity.
That's so interesting. And the airlines have always sort of struggled with this capacity, how to get that balance right. Peter, are there any airlines that are are navigating this better than some of the others, either because of the circumstances, they're not as exposed to, say, Boeing, or because execution-wise they're doing a better job?
Well, I think the one of the big problems that we're not talking about that make airlines less profitable than they were pre-pandemic is labor costs. You negotiate with the union, you step up 30 to 40%, which has been the rate we've seen, and then you stay there. So this has been a drag, and whether it's pilots, mechanics, flight attendants, they're all getting more money. But Delta Airlines has been the one that has found a way to navigate this better than others. Extremely loyal business travelers, a very good fleet, clean balance sheet, no real need for major investments the way, let's say, American had to do a big refresh on their fleet pre-pandemic, borrowed a lot of money to do things like that, or United, as we talked about a bit earlier, with this aggressive growth strategy that they have. But I think kind of the unhidden or the unappreciated asset that Delta has is their tech ops business that allows them to do their own maintenance, repair, and overhaul, which we started seeing engine problems last summer. That has grounded a lot of Airbus planes. This hit JetBlue and a few others a bit more, but Delta seems to be the one that has navigated best.
You agree with that, George? Would you say Delta, if you were to look across, the industry seems to be navigating this most effectively?
Definitely, we totally agree there. So I think if you look at the U.S. market, it's Delta and United that are performing better than all the other airlines. I think that's a function of both premium leisure travel and business travel demand and long haul. I think long haul is generally performing better than short haul now, right? So if you're going inside a continent, I think things are very competitive because there's a lot of low cost carriers that will compete, with you, even if you're a full service carrier, to carry those passengers. So fares are under pressure. But I think still this summer you'll see good fares into Europe, pretty good fares into Asia Pacific, and that helps Delta and United the most in the U.S.
George, do you think that the whole labor issue here, and both the difficulty of finding staff and also the higher wages to pay them, do you think that is a problem that's just here to stay?
So I do, and so we've written a report on this as well. It's on the Bloomberg service. So when we looked at retirements that were coming, we used airlinepilotcentral.com, which I think is fairly reputable, but I will admit, we could sort of dive in and get the numbers exactly ourselves. But when we looked at their numbers on retirements, we think retirements are going to peak 2026, 2027. I think it's sort of similar to the dynamics in the rest of the economy, where a lot of baby boomers came into a lot of these businesses and they're retiring now in larger numbers. Pilots are really hard to replace because they're highly trained. Takes years and years to get trained up to get into a cockpit. And they're the ones getting sort of the 20% increases at the last pay negotiation. I suspect they may get that similar number. Actually, maybe not as high as 20, but they may get pretty high numbers mid-decade when they do this again. So, yep, that's a big problem right now with airlines.
One other question I had, Peter, and I realize this sounds like a smaller question, but just from a consumer point of view, I'm interested to get your take. You see this trend of airlines raising bag fees. Is that a smart way to raise more revenue, or do you risk alienating your customer? How do you think about it?
Well, look, once one airline does it and it follows another and then another, it's just going to be the way it is. Like, we eliminated change fees, during the pandemic. At some point, that's going to come back too. It is a valuable source of revenue that the airlines, will pull on at some point. It's part of the prescription. I see that Elliott has. The activist for Southwest is to introduce more bag fees, but these companies are trying to grow profits, and that's one more way to do it.
I mean, George, it's not just the bag fees, right? I mean, at this point, I feel like I'm paying up to not sit on a cardboard box on the plane. It's got it's everything is in these tiers, and I sort of agree with Josh here. At what point do you risk alienation? Although I guess your choice is just not to fly at all.
Yeah, I think that's about right. I think everywhere you go now, the revenue managers are looking for different ways to slice and dice the airplane cabin and figure out what they can get people to pay for, right? And so the challenge is to find more things to sell. And in the old days, those are things you and I just got for free, got by luck when we got, an exit aisle or something like that. And so that's the new formula for increasing revenue. Delta does it, I think, better than most others. I think it may be here to stay and hard to avoid.
All right. Peter, George, we're going to leave it there. Thanks, guys, for joining the show today. Appreciate it.
Enjoy it. Thank you.
While we are wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for market domination overtime.
There is the closing bell on Wall Street, and now it is market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let us start with where the major averages ended up, and we had sort of a stalling out of momentum today. Now, the Dow has been sort of the underperformer this week, so it fell today by about 58 points right now. As we look at the 5-day chart here, it was also down this week by about 0.5%. We have been seeing better performance from the S&P 500, but again, it sort of stalled out today, not seeing much change really at all. But on the week, still a healthy 1.5% gain, help being fueled by, of course, CPI on Wednesday, as well as the Fed that didn't seem to really upset the apple cart, and some strong performance from large cap tech. And speaking of that last, the Nasdaq, after really bouncing around between negative and positive today, eking out a gain of 0.1% by day's end, and again closing at a record. The Nasdaq 5-day chart up 3%. So it was definitely the winner on the week. Now let's send it over to Jared for a closer look at today's action.
Thank you, Julie. And let's go to the Wi-Fi Interactive. I'm going to check the sector action. What you're looking at, that was a Nasdaq 100. We'll take a look at that in a second. What I want to show you is we are just far and away. This has been a week of tech. Now today we got tech and communication services tied in the lead for a whopping 3% or 1/3%. But here's a 5-day action. Only XLK, that's the tech sector, only XLK has outperformed, and it is outperformed by a large margin, 5.6%. Now I'm going to switch over to the Nasdaq 100. This is the entire week, but you can see here Microsoft, Apple, Nvidia, so many record highs this week. Among the three of them, Apple just really bouncing back here. And that has been the story, because I'll tell you what, you take a look at the week's action in all 100 Nasdaq stocks or Nasdaq 100 stocks, and we have more than half of them in the red. And you take a look at the Dow here, most of them in the red. You don't even fill out the top line there. So there's not a lot of strength under the surface here, but those mega caps really keeping things afloat. And finally, here's our leaders index for the week. New York FANG, we know what that is. That's up the most, 5.3%, but then chip stocks, then the Qs, then software. And this has been interesting because we've seen software flagging recently, not this week. With the comeback of Microsoft to fresh records, we got Oracle up almost 10%, Adobe 13%, and the list goes on there. You can also take a look at the semiconductors. So we already saw strength in them. That strength is continuing. Looks like Mobileye down about 10%, AMD down 5%. But other than that, a really strong showing. I'm going to leave it on the Nasdaq 100, what we saw today. This is today only, and we're seeing some strength in Adobe. That's due to earnings yesterday, 14.5%. And then Broadcom, another record high there too. Josh.
Thank you, Jared. Markets finishing out the week on a mixed note here. The Nasdaq, the only index closing higher, but the S&P 500, Nasdaq able to notch weekly gains. Weak reading on consumer sentiment this morning. Weighing on markets today. Joining us now is Ryan Dietrich, Carson Group Chief Market Strategist. Ryan, good to see you, sir.
Thank you for having me. It's getting a little hot in your city. I'll tell you, a little warm walking over.
Trying to keep it cooler in here.
It's June.
It is June. It should be, but I'm glad to be here, guys. Thank you for having me.
Ryan, let me listen. It's Friday. We're rolling into the weekend. It feels like a good time. Take a breath, take a pause. We had a lot of news this week. What were kind of some of your big takeaways from this week? And maybe what do you think it kind of tells you about what's on the way for this market?
Sure. I mean, we just barely missed the S&P higher today, which would have been all 5 days of an all-time high. I know we missed it, but that's only would have happened 16 other times in history. So that tells you right now that's pretty rare to see what we're seeing. But listen, I'm not going to say anything we probably don't already know. It's all, to us, at Carson Group, it's all about the inflation, right? We know the CPI data, we know the PPI data, but also, New York Fed, consumer, what do they expect on inflation 1 year out? That's back to pre-pandemic levels. Look at the ISMs, ISM manufacturing and services. Both those prices paid are back to 2018 levels. I mean, inflation's not perfect, we're aware, but we're starting to see some big time improvements in that CPI. I've proved it. One more thing. On PCE, there's well over 100 components. We looked at core PCE. 30% of those components, Josh, are negative year over year. There's some deflation taking place. People don't realize it. So those are some positive things this week.
Well, I think the people don't realize it is an important part of what you just said, right? Because consumer confidence came in today, consumer sentiment came in below estimates, right? And we're starting to see, definitely, at the very least, at the low end of the consumer spectrum, the people are not spending as much, or they're making different choices. That's why prices are coming down for stuff. So how big of an obstacle is that when it comes to market returns going forward?
It is a small obstacle. Also, I guess initial claims, right? They've been surging. Surging might be the wrong way to put it, but creeping up is a better way to put it. So you're right. Now listen, though the Michigan consumer confidence, it's fairly volatile, but still it's very low. And this is such a unique market because overall the consumer is still spending, right? I mean, the city's bustling, people are still out there, but we're seeing those delinquencies creep up on credit cards and a little late on car payments and things. And it is, there's no easy way to put it, but I will just say this, the top 40% who truly drive the economy are still in good shape. And as someone who's a steward of assets, we continue to think the consumer is fairly healthy overall, and it should still lead to a bull market like we've been saying for a while.
And so bottom line for the market, Ryan, you still, bullish, stay long equities?
We've been overweight equity since December of 22, right? And one interesting factoid, people like these, maybe, here's the way I say this, maybe May was a signal, right? We had a really good May on the S&P, gained over 4%. We took a look. That's not, usually May is not that great. So let's be very clear. When you have a good May like that, the rest of the year is up over 10% on average, like double your at any time returns. It's just one stat, I understand. But when you start laying these on top of each other, we continue to think this is a bull market. And I get it. We can get into participation, only 5 stocks, 7 stocks, whatever you want to say. And that's true. But overall, we still think stocks are going to be higher from here to the end of the year. And honestly, small mid caps might kind of take the baton. I know that's kind of a dirty word a lot of places, but we think that it could happen.
All right, so let's get into participation a little bit more because I know you saw our chart of the day today, courtesy of Josh Schaefer, where he said, a lot of the Wall Street banks are coming out with their mid-year outlooks, and a lot of them are calling for a broadening in earnings. Right. Now, this is not the first time we've heard this, right? And we did see a little bit of broadening earlier in the year in returns, stock returns, and then it went right back to the magnificent however many. Yeah. So is it going to happen?
We think so. And again, your chart there, what it showed was kind of, I think it was the top 7, right? The Mag 7 versus the 493, and those 493 are coming back. But also, if you look at the S&P 600, there is explosive growth expected to come from the S&P 600 the second half of this year and early into next year. And our base case, again, like we kind of hinted at here, if the economy stays strong, like we think it will, we've got strong productivity, still a consumer with some cracks, but not major cracks in our opinion. We're creating as many autos as we were pre-pandemic. I mean, there are some real positive things taking place. Oh, by the way, earnings, like we just talked about, earnings keep coming in better than expected. So yeah, we think some broadening out makes sense. And again, if you think about an average investor listening, well, market is pricey. I mean, large caps are pricey, tech is pricey. Doesn't mean you shouldn't own it because they're doing very well. But at the same time, small caps relative to large are the cheapest they've been since 1999. There's a 13-year period of outperformance. Listen, it's Lucy and the football. People have said small caps for a while, myself included. We've been bullish, but we said small caps maybe. But still, before the end of the year, we think there's a good chance it could happen, probably because we're going to see better inflation coming real soon, and that opens the door. We're in the camp of 2 cuts. We've always been in the camp of 2 cuts. September, November, we think it's possible, or likely, I should say.
So Ryan, so the overall market, okay, it's looking kind of pricey, but are there sectors you think in the SPX that look more attractively valued to you?
Great point. I mean, yes, so small and mid caps specifically, but then getting to the sector level, we like to look at 20 years out, past 20 years, looking at 2 standard deviation, what's pricey, what's not. Financials are fairly cheap. Now, I know they've kind of struggled, regional banks have kind of struggled, but that's one area we do like. Industrials, they're kind of right in line with where they've been over the past 20 years from a price point of view, but financials and industrials are 2 that are not pricey, let's just put it that way, that we think if the economy can do well, like we think it can, they should continue to do pretty well here.
And that's interesting because the conversation's been coming up a little bit lately about value again, right? So, and there's a lot of debate over what value means and what the value indices look like, et cetera. But it sounds like that is an area that you think is worth looking at.
Yeah, that's a great point because, I mean, obviously utilities have done very, very well this year, right? Now, staples, not as much. And the only sector down on the year, I believe, at least as of lunchtime, was real estate, right? So that's in there as well. But we like the cyclical value areas, to be specific. Your financials and industrials and maybe a little bit of energy in there as well. Energy's pulled back, obviously, but you talk about earnings growth, and there's potentially a lot of earnings growth coming from energy as well going forward here.
Ryan, good to see you. Thanks for coming in.
Yeah, thank you. Enjoying your city. Thanks for having me.
Excellent. I hope it's not too hot. Maybe you need.
I'm taking this off like.
Yeah, I was
really
going to say, go buy a New York City T-shirt. There you go. All right, still to come. Inflation beginning to make its way back to normal levels. What's that mean for President Biden's election odds? We'll discuss in the latest edition of Bidenomics when Market Domination Overtime returns.
Inflation beginning to make its way back to normal levels, a step in the right direction for President Biden's re-election odds, but there's still some concerns lurking in the shadows. Yahoo Finance's senior columnist Rick Newman joins us now with more. Rick.
Hey, guys. I feel like I could just pick up where Ryan left off. I mean, he was talking about jobless claims, for example, people filing for unemployment insurance. There was a jump in that number this week. That definitely got economists' attention. I mean, the old saying is one number doesn't make a trend, but compare that with some other things we know. We've seen a big decline in the number of job openings, still higher than before COVID, but that's been coming down a lot. And anecdotally, you're hearing a lot of the retail chains, Walmart, Target, Walgreens, say they're lowering prices, which is a good thing. But the reason they're doing it is that people are just not spending money anymore. At the same time, we know the so-called excess savings that people put in the bank during COVID, that is basically all gone. So I mean, this is, one of those sort of softening scenarios. I'm not ringing recession bells here, but I'm watching a lot of economists who say this bears watching. This could be the labor market slowdown that many have been anticipating for some time. And what does that mean for President Biden? I mean, inflation is finally going his way. It could be more or less back to normal levels, at least with regard to goods by the fall. But what if we suddenly start to have softness in the labor market and people start to get worried about job security and they start to even possibly see layoffs happening around them? I mean, in a way, it almost seems like Biden can't win on the economy. So we're not there yet. Bears watching.
Well, Rick, and let's talk a little bit more about how the White House is framing this right now that we have these latest inflation numbers. I'm curious, this has been the problem all along from the perspective of the White House, I guess, is that people are not really accepting that the economy is doing okay. Now, if it's going to be doing a little bit worse, that makes their job even harder.
Exactly right. And I guess the way I would phrase it, Julie, is there aren't enough people, not enough Americans think the economy is doing okay. I mean, there certainly are plenty of people who are doing okay. I mean, anybody with a stock market portfolio, which according to Gallup is like 60% of Americans, they're watching their nest egg go up in value. If you're lucky enough to own a home for the last few years, you probably refinanced your mortgage at around 3%. So a lot of those people are doing okay. It's just not enough for Biden. And that's why he consistently lags Trump when it comes to approval on the economy and why his overall approval is just so weak. So, Biden basically has the same line when he talks about the economy. He brags about everything that's going right, record number of jobs created under his presidency. That is accurate. But then he says we have more work to do on inflation. We have to keep working to get inflation down. And voters, either they're not buying it really, or they're just not even listening to Biden, because there's no evidence that he's getting more credit for the economy, even as prices have come down. And gas prices, by the way, have been coming down. So Biden just needs all those trends to continue and hope he can just persuade enough people in the fall that things are okay. I mean, this is going to be a very narrow margin of victory no matter who wins. So that's what Biden's hoping for.
Rick, just quickly, I'm curious. We talked yesterday, I believe, about former President Trump meeting with a bunch of CEOs and sort of making his pitch on taxes. We did hear some news on Biden's tax plans this week. Do we know, though, what kind of meetings he's having with CEOs and if he's trying to make his pitch directly to them?
I think what Biden is trying to do is basically be presidential. I mean, this is what an incumbent president is supposed to do to get reelected. So it could have just been a coincidence of the schedule. But Biden this week was over in Europe talking with other leaders of the so-called G7 countries, mingling among the most powerful people in the world. So I guess he's sort of trying to communicate his position by the bully pulpit he has as being a world leader, participating in some of the most important decisions in the world. But we're going to hear more about all of this directly from Biden. Don't forget the debate is coming up on June 27. That is must-watch TV. And if it's too late for anybody out there in the audience, I will be watching it and detailing everything. That is when Biden is really going to be able to make his pitch. And then we'll have another debate in the fall. I think those are going to be pretty important this year. And for anybody who hasn't made up their mind yet, and there are some of those people, they will get to hear what these two guys have to say. And that could help them make up their minds.
We shall see. Rick, thank you. Thanks in advance for watching the debate and keeping track of it, too. Have a great weekend.
Anytime. See ya.
Well, Elon Musk's famous optimism is just one of the reasons that Tesla shareholders voted to approve a pay package for the CEO that could be worth as much as $56 billion.
I think just based on vehicle autonomy, we can 10x, more than 10x the value of the company. I believe that's what will happen.
He believes that's what will happen. Will it? Who knows? Where does Musk and the EV maker, where do they go from here? Joining us now is Gautam Mukunda, Fletcher School of Law and Diplomacy lecturer and author of Picking Presidents. It's good to see you again, Gautam. So you recently wrote about that you did not necessarily think that Musk is the right leader for Tesla right now. Shareholders seem to disagree, and they're willing to pay him for the privilege of having him continue to run Tesla for now. What do you think that he now even has more of sort of carte blanche to run Tesla as he would like?
He won, and it wasn't a close call, right? He won by a lot, and so there's no way he doesn't interpret this as something of a free hand, and he should. I mean, like, shareholders have supported him even after a more than 50% drop in the stock valuation of the company over the last few years. That's a pretty remarkable statement of confidence on their part. And I'll just turn to sort of what I said was, it does not take anything away from the enormous scale of his achievements in building Tesla, and not just Tesla, right? Tesla is not his most impressive company. I would say that's SpaceX. So either one of these companies would be remarkable. Both combined is even more so. It doesn't take anything away from the scale of those achievements to say that the challenges that Tesla is facing now are not the same as the challenges that he triumphed over earlier, and it might take a very different skill set for those.
And so, Gautam, are you implying then, that maybe they should somebody on the bench at Tesla should be being groomed here to take his role at some point?
So Tesla is unique, right? Because you cannot imagine Tesla without Elon Musk. I mean, like, you could say you couldn't imagine Ford without Henry Ford, but eventually that problem had to be faced. In Tesla's case, well, I don't know what Tesla's valuation would be without Elon, but it would be a lot lower. My suggestion would actually be a little different from that. It's that the board should take a much more independent and active role in the company. What I would say is that there is no such thing as a genius so brilliant that all of their ideas are good ones, or even their good ideas can't be improved by pressure from other smart, capable people. I think the board has given him sort of total freedom to do whatever he wants in ways that, the last few years of Tesla's performance, just they're not working as well as they used to. And it's time for them to step in for things like, the Cybertruck, for example. Maybe when that was decided to devote a huge fraction of the resources of the company to that, the board should have stepped in and said, does this really make sense? Can you really make a case as to why I do this? What's the analysis to why this is a good idea? And it would have turned out, maybe the decisions would have turned out a little bit different.
It doesn't seem like there's any chance of that imminently, certainly, that's going to be happening. And in the meantime, he had made this threat against the company that he was going to take his attentions elsewhere if this pay package didn't pass. And now that seems to have dissipated. But just as a reminder, he runs a lot of companies, right? Tesla's not his only company. He runs X, of course. There's SpaceX. There's XAI. And so going forward, does this sort of draw him back to Tesla to some extent because he did get this victory?
I mean, it's hard to know. Remember that before this whole debate over this current pay package, he had actually said that his expectation would be that there would be another even larger one that would be granted to him after this one came through. So, I mean, he has sort of already said that this is not enough. Now, that being, once he said it, like, it's easy to say that, well, he mean it was that just a bargaining thing, but it's kind of a striking thing for him to say that that 25% of the company is not enough. I'll also say it's a little hard to see how that threat is plausible. Tesla is by far his largest source of liquid wealth. And, for him to monetize his assets in SpaceX, for example, would be pretty complicated. And so I'm not sure he has the ability to walk away. But he's Elon Musk. He does lots of things that no one else would do. I would never say anything is impossible. I would be concerned if I was the board, and I would look very closely at, again, the SpaceX model, right? So Elon does not run SpaceX on a day-to-day basis. That's Wynne Shotwell, and she's done an extraordinary job. She is, by most measures, I think, has a really good argument to be the greatest aviation executive of the last 50 years, maybe more than that. It might be time for the board to say, hey, if you want to spend your time on other things, let's find a Wynne Shotwell for Tesla who can be your partner, not your replacement.
Hey, Gautam, switching gears just a bit here. As we talk about these pay packages and compensation, they're amazing, Gautam. I mean, we can talk about Elon Musk and that pay package. Larry Ellison, who is friends with Elon Musk, Forbes saying his net worth jumped 15 billion. His net worth, it just jumped 15 billion. As Oracle, of course, hit an all-time high this week. It's just jaw-dropping numbers, Gautam. Have we ever seen a moment in time like this before with these kind of numbers?
Probably. So this kind of numbers, no, because you have to correct for inflation, right? But correcting for inflation, the parallel would be the Gilded Age. I'll just note, for example, that when Standard Oil was at its peak, if you correct for inflation, John D. Rockefeller had an income, not a wealth, an income well in excess of $20 billion a year, right? Sort of, even Elon Musk would go, wow, that is a lot of money.
It's good to be the king.
Yeah, it's good to be the king. Yeah, especially one. So we have seen eras like this, but what's worth noting is when we see eras like this, there is always a correction, right? The Gilded Age was followed by the Progressive Era, ages of reform. When you are in the United States, where median income has basically stagnated for about 45 years, I think people are going to push back and say, does it make a lot of sense for however valuable you might think a CEO is? They're probably, let's put this in context. I think the top 5 hedge fund managers got paid more than every public school teacher in the United States combined. Okay? So you can believe that hedge funds are amazing. You can believe they're valuable. You can believe that these are the 5 greatest investors who've ever lived. And I would still say that the value they created for the economy is not as much as the entire American public school system put together. That is not a plausible argument. And so it would not be surprising for society to push on that and say, it is time for there to be a reform movement to get this to get this rebalanced in a way that's healthier for the rest of us. And the counsel I'd give to all of these people is like, if you push the system too far, it will break in ways that you do not like, right? You are better off leading by pushing reform and saying, let's make life better for everybody, than you are pushing the system to its limits.
So Gautam, is this the top? Was this Elon pay package the top, or the one that he's about to get maybe if he asks for even a bigger one? Is that the tipping point?
Well, presumably if he asks for a bigger one, he's going to have to generate the same kind of returns that he did before. Given Tesla's current market cap, right? It's in almost $500 billion. Doing another 10x gets you into a set of calculations about where its valuation comes from. That's a stretch, right? That's going to be hard to do. It's going to be even for Elon Musk. That's a big one. What I would say is, I don't know where the breaking point will come, because it'll be it will take us all by surprise. But you can tell that it is coming, right? The United States is currently consumed by a gigantic populist revolt. Some parts of that are clearly about income inequality, even if it has manifested in the role of a political candidate who just got away from promising CEOs that he was going to cut their taxes just a couple of days ago. There are going to be responses to this, and we should really be thinking about how to channel that in a way that's productive and not unproductive for society. If I were Elon Musk, I would sort of be saying, I have done the impossible, right? Which give him credit. He has done the impossible with his companies. But when we look at, again, think back to John D. Rockefeller, he was the most hated man in America when he was its wealthiest. Right? What he did to rebuild his reputation was to create the Rockefeller Foundation and sort of distribute that wealth to the people in ways that completely transformed his legacy. I think, I personally am a huge fan of the space business and think that Elon's goal of building out the space industry is laudable. I suspect that's not going to be enough given his other behaviors and the way in which he's alienating a lot of people.
Gautam, thank you so much for your perspective as always. We really love talking to you about this stuff.
Thank you. Great to be with you.
Thanks. Have a good weekend. Well, that'll do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. The battle may be won, but the war is far from over. Elon Musk pay package getting the okay for more than 70% of Tesla shareholders. Now, the fate of Musk's payout heads back to the judge who struck it down, and it is not certain yesterday's vote will be enough to tip the scale. And though momentum is soured in today's trade, the S&P 500 closed out a winning week after hitting multiple new record highs. Investors cheered encouraging signs in the fight against inflation after the Fed held rates steady. Now they hope the trend will continue in a steady stream of data in the coming weeks. Plus, the AI story is alive and well, driving Apple's market cap briefly above that of Microsoft after the iPhone maker announced its AI strategy early this week. But the gains were short-lived, Apple ending the week behind Microsoft once again, with NVIDIA as a close third. According to a Thursday post on Reddit, Keith Gill, aka Roaring Kitty, is now one of GameStop's largest shareholders. The Redditor who helped spark the meme stock craze shared he currently holds more than 9 million shares of the video game retailer, and that stake leaves just 3 other investors in front of him: BlackRock, Vanguard, and GameStop CEO Ryan Cohen's investment firm. But let's take a step back to before this latest meme rally was ignited, before the GameStop surge of 2021, and take a look at the subreddit that helped start it all, Wall Street Bets. Nathaniel Popper is a journalist and the author of The Trolls of Wall Street, How the Outcasts and Degenerates Are Hacking the Markets, and he joins me now. Nathaniel, it is great to see you. You know, it's interesting, Nathaniel, the meme stock craze. I bet there are plenty of folks who thought, you know, this is fun, it's entertaining, but it's going to fade. It's going to come and go. But you know what? It's June 2024, Nathaniel, and we are still talking about it.
When I started writing this book about the trolls, as I call them, you know, I have to say I didn't think it was going to be alive in quite this way, you know, when I actually finished the book. But you know, what I saw, what made me want to write a book about this new world of online trading and investing is the fact that this had much deeper roots than most people understood. And it was much more broad-based in the markets. And there are just millions of young Americans, particularly young men, who are obsessed with the markets. And that, you know, people keep thinking that's going to go away, but it hasn't gone away because it's bigger than I think people understand.
And are there differences, Nathaniel, between, let's say, now and 2021 that you see in terms of the trend and the theme? And as you point out, you would argue it's broadening?
Yeah, I mean, I think it's funny that right now we are once again paying attention to meme stocks. Meme stocks are certainly a part of this. But since 2021, you know, since that moment in 2021 when GameStop first really took off, you've gotten millions of more people into the markets. And what's happened over time is they've actually, in broad terms, moved away from the most speculative plays and from meme stocks. So meme stocks have become actually a smaller portion of the retail action over time. What I trace in my book and what I find so interesting is that this retail crowd, you know, they're often called the dumb money, but they've sort of learned over time. They figured out that there are smart investments and dumb investments, and they've generally moved in the direction of smart investments. And so even though, you know, meme stocks are a part of it, they've actually become a smaller part over time.
I'm interested, Nathaniel, you know, I got a buddy, he used to be a trader at Goldman, and he once told me, you know, I'm not any smarter than the retail trader. I just have much, much better tools. Hey, that counts for a lot. And I guess I'm interested, Nathaniel, when you know, you're talking to the folks you're talking to for your book, some of them are making money, but, you know, are a lot of them making money? I mean, do we have any kind of line of sight there?
There are a lot of interesting new data sources coming online that give us some insights into that. And what the data I find the most interesting looks at the aggregate sort of retail positions in individual stocks. So this is taking sort of retail traders and removing the mutual funds, removing retirement investing, just looking at individual stock purchases. And when you look at that portfolio over time, they have done, according to Vanda Research, which is one company that tracks this in really interesting detail, that retail portfolio has done better over time than the S&P 500. You know, the classic way to think about, are you beating the market, is, are you doing better than the indexes? And retail have, at most points, outperformed the indexes over the last 10 years, over the last 5 years, over the last 3 years. Now, that may be an artifact of this moment in the markets when, you know, sort of speculative, future-looking companies, you know, AI companies, Tesla, electric car companies have been doing well. But, you know, the retail crowd has taken risks and it's paid off in broad terms. Now, of course, there have been sort of these tremendously sad stories, big losses. You know, when you go on Wall Street Bets, I trace this all through the community Wall Street Bets. You know, being honest about your losses was a big part of the allure and the appeal of Wall Street Bets. But what you've seen over time is that when you see people losing, you have an opportunity to learn.
Nathaniel, such a great, super interesting conversation. I wish we had more time, but thank you so much for joining the show, Nathaniel. Appreciate it.
Thanks for having me.
The Nasdaq and S&P 500 lock in a winning week as the Nasdaq closes at another record. Here with more on the trading day takeaways, let's get to Yahoo Finance's very own Jared Blickery. Jared.
Apple is back. That's my biggest takeaway for the week. We surged to record highs finally after a lull in the action. And let's go to our Nasdaq 100 heat map here where I'm going to show the price action for the week. There you go. What you're going to first notice, guess what? Apple was on top yesterday. It's not on top today. I had a losing day and Microsoft is bigger by just a hair, but check out NVIDIA right by it there. I'm going to change this to intraday and then actually to market cap, and you can see how close these are. Josh, NVIDIA just creeping up on Apple, which is creeping up on Microsoft. These three could easily switch place any day here. But why Apple? Why is this important? Well, I presented this earlier in the week. When Apple breaks out the way it has, it tends to get continuation. This shows what happens a day, a week, a month, quarter, a year later. On average, 33% in gains a year later, percent positive 88% of the time. Not quite as good when you go down to a week later, but still, these are really solid gains. And one more thing, Josh, I want to show you, I prepared this at the beginning of the year.
It looks pretty good for a bit, but then look at that, September.
Bad for Apple. This goes all the way back to 1982. So basically 40 years of history here. And you can see June, also a negative month. Okay, we're in June right now, but obviously it's not a negative month for Apple just yet. But all that shows is that this is going to be an incredible tailwind potentially in July or August when a stock bucks seasonality. So Apple being positive right now, that just means that the tailwinds are that much more bullish.
It's so interesting that because I wonder how much of this is folks is this just excitement building for Tim Cook taking the stage?
You know
showing you those new iPhones, sell the news?
Yeah, I think a lot of it was WWDC tends to happen in June, so maybe a sell the news event. But this goes back 40 years. I found this seasonality, this exists pre-iPhone. You can go back to the 90s and you will still see these patterns. So pretty powerful there. No, we got to move on. So we got to talk about the record stocks that we had in stocks this week. Those records in light of CPI, in light of the Fed. Now, this is another chart I update periodically. This goes back to the beginning of the bull market in October of 2022. This purple line is SPY, so it's basically the S&P 500. And these other lines show you how the market reacted on different report days. So for instance, CPI is in blue, that's all the way up here. This produced 16 net SPY points over the last, year and a half or so. And then you have the jobs report, that's about 8 or 9 points. What's interesting is the Fed decision, that
Are you telling me Jay Powell doesn't matter? Is that what this is telling me?
Very interesting. What I think we can glean from this is that there's not that much event risk on Fed Day. In other words, the Fed is doing a decent job of communication. So if you remember way back when Powell started this whole thing at the Fed, He was event risk. This guy could tank the market with any press conference. That's not what we're seeing anymore, so maybe he's learned.
All right. Third point, Jared.
You got it. Cash on the sidelines at a record. Latest B of A money market fund tally is showing we are well north of $6 trillion in assets. This goes back to before the global financial crisis. And what I want to show you is these peaks here, because we are at another peak. Here's a peak. This peaked in January of 2009. This peak was May of 2020. And these peaks coincide with a change in interest rates. So when you see this going up, that's because money market rates are going up. Short-term interest rates are going up as the Fed. But when the Fed pivots, thinks about cutting rates, that's when we see money market funds compared to these rates are not as competitive anymore. So we saw this big rush of money out of money market funds in the wake of the global financial crisis, went into stocks. Same thing in 2020, in the latter part of 2020. And what are we going to get this time?
Now, where does it flow into, Jerry?
Exactly.
Where does it go?
It's all going into GameStop, obviously, meme stock. No, it's going to go, it depends on how quickly the Fed comes down in interest rates, but, this money generally goes into risk assets.
All right, Jared Blickery, thank you, my friend. That was great. Still to come, while AI and tech IPOs have been all the rage this year, there is one fast casual restaurant chain that, while still new, is lapping the competition. Stay tuned. More Asking for a Trend on the other side. It's 1 year since Cava went public, and the rally since its debut is capturing Wall Street's attention. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, because of how the stock is done since it went public a year ago, the valuation has gone higher. And there's an interesting way to look at that valuation through the prism of how many outlets it has. Cava, of course, the Mediterranean fast casual chain. Some have called it the Mediterranean Chipotle, in fact, so it makes sense to compare it with that company. The shares, the company went public on June 14th last year at $22 a share, started trading at northwards of $45 a share, and they've quadrupled from the IPO price. They've doubled since that first trade here. So we've seen the valuation go to about $10.25 billion. If you break that down into a per restaurant valuation, it has 323 restaurants. You get a valuation per restaurant here of somewhere like $33 million per restaurant. So it's pretty astonishing to see the comparison with some of the other restaurants. Chipotle doesn't see that kind of valuation per restaurant. Chipotle has a lot more locations. Sweet Green, even Portillo's, Shake Shack, and Wingstop are some of the others that we're looking at to compare here. And even if you think that we will see a Chipotleization of Cava, so to speak, that kind of growth, still, it is a relatively lofty valuation when you look at it in these kinds of terms.
And Julie, after a run like this, analysts who cover this name, what do they think? They think it's worth it here?
Yeah, I mean, another way to sort of compare it with Chipotle is to look at how many buy ratings you've got. About 2/3 of the analysts who cover Chipotle have buy ratings. Just over half have buy ratings for Cava. And there have been a couple of downgrades recently. JP Morgan recently cutting the stock to neutral from overweight and said that this level of valuation is unprecedented. That's where the $33 million valuation per store comes from. Piper Sandler also recently cutting its recommendation to neutral from overweight, excuse me. So there has been a little bit of pulling back on enthusiasm for this stock. By the way, speaking of pulling back on enthusiasm, Ron Shaich, who is the chair of the company, he sold about 123 million of his shares worth $107 million. That news coming in a filing on Monday, and the largest shareholder of the company, International SCA Artal, also selling part of its stake in that company. So we've seen insiders selling a little bit, and also some of the analysts who are fans getting a little bit more tepid on those shares.
All right, Julie, thank you. Appreciate it. In the world of fast food, companies are rolling out value meals to keep consumers coming back. As inflation, we know, stays high, McDonald's announced earlier this year that a new $5 meal deal is coming later this month. For $5, customers can get a McChicken or McDouble 4-piece chicken nuggets, fries, and a drink. Getting hungry just thinking about it. And it's not alone. Rival Burger King also launching a $5 meal deal, even ahead of McDonald's. And just this week, breakfast foods are getting into the trend as well. Starbucks launching a pairings menu that offers customers a drink and breakfast item combo from anywhere between $5 and $7. Also throwing their hats into the ring, Wendy's and Popeyes. But the question remains, how will these deals translate to traffic and revenue? And here to help us sort through all that is RJ Hottovy, head of analytical research at Placer.ai. RJ, you are just the man to talk to about this. So the deals, they're coming fast and furious, RJ. Is it going to work? Is it going to drive traffic?
Yeah, so far, I think they have been successful. And it's not just the QSR guys that are getting into the game, it's the casual diners themselves. As you mentioned, Burger King is front-running McDonald's in a lot of ways by offering its own $5 value menu. And we just looked at the data this week for how visitation trends are doing year over year. And we saw definitive acceleration in the last 2 weeks of Burger King visitation trends. So value is front and center on consumers' minds right now. I think McDonald's is also going to see a similar pop when we look at the numbers after the launch on June 25th. Chili's, Buffalo Wild Wings, all these promotional deals right now are the key thing that are driving visits across the restaurant industry. And why is that? Because we saw a lot of visitation lost to things like value grocers and discount stores and even convenience stores are another channel that we've seen it. And this is the restaurant's way of recapturing that lost market share. A little bit it's being helped out by food at home inflation coming down a bit. They're able to withstand a little bit more on the discounting side. But really, this is a way to get back in the battle because there has been market share loss the last couple of months.
And RJ, as listen, you're an investor and you're listening to this, and you're in some of these names, and you're hearing about all these deals. How should you be thinking about margins and the impact there?
Yeah, I think we're going to see a margin hit here too. I mean, some of these very extreme value promotions, I think that there will be a near-term margin hit. I think that goes without saying. Yes, there's going to be incremental visits because of that, but I do think at the end of the day, just where we are in terms of cost pressures, especially when we add on labor and other things, I think we will look at a margin hit. The key is whether or not the visit frequency can sustain itself. Can they have that consumer who comes in for that value menu come back and maybe pay full price? And that's a big question right now as to how sustainable that is, because we are not going to see value grocers and other convenience stores and other channels lay down. They are going to get in the promotional game as well. So it's going to be very competitive. I think this summer really is going to go down as the summer of value wars for the restaurant category.
And let me ask you, RJ, you know this space so well. As you look at this sector, you study it, you see the themes, what is it telling you about the state of the consumer here? How healthy, how resilient do you think the consumer is?
Yeah, I think it really kind of shows more of a K-shaped, recovery in where we are post-pandemic. I do think that lower income consumer remains under pressure, and a lot of that is the cumulative effect of inflation that we've seen in the last couple of years. If you look where we are, food inflation compared to the start or the right after the pandemic, we're still up about 30%. And even though that has slowed down this year, that still is a big chunk of discretionary spend that consumers are giving up just from inflation there. Other things are starting to creep into, whether that's insurance, whether that's or other service-oriented type factors, healthcare being another one in there as well. I think we're looking at a consumer that is really looking to stretch their household budgets. Interestingly, we do see that consumers are still willing to spend for big events and activities and holidays, but it's those shoulder periods in between that consumers are really taking a pause right now, and we've seen trade down or trade out in a lot of cases. So I think it's a situation where this right now really has to be the focal point for not only restaurants, but a lot of anything catering to the kind of that lower to middle income consumer. It really is that low price point that consumers are fixated on, and it's what really is driving visits, but also innovation too. It has to be low prices or competitive prices, but also something new. It can't be just something that you could get anywhere else. It has to be something differentiated. And I know that's tough to say, but if you look at kind of the winners of the last couple, really the last year or so in this food retail space, Aldi, Trader Joe's, which are low prices, but innovators as well. And I think the restaurant guys are starting to figure out that innovation plus value is the key to driving visits.
RJ, I'll get you out of here on this. Given kind of your broad views on the market, the consumer, are there certain names in fast food, fast casual, RJ, that you think are just better positioned than others?
Yeah, it's a great question. And looking across the board, I mean, I do think some of the casual dining chains that are starting to really see a turnaround in visitation trends that maybe have gotten not as much love as they should have gotten. So Brinker International, which is the parent company of Chili's, I think is really interesting with kind of the visitation trends we've started to see there. Looking kind of broadly, McDonald's is another one that I think will be very interesting to see the success of this value menu launch. There's an interesting story on that one. And I think that they're starting to find that they can innovate around that as well. So those would be two names that just pop off top of head here. It could be interesting to see in terms of where we are in visitation trends, because I think those do generally have a pretty good correlation with where we end up seeing these stocks go over time. So,
RJ, great to have you on the show. Great to have you in this insight. Have a great weekend.
You too. Thanks, Josh.
Coming up, it's what to watch for next week. I'm going to tell you everything you need to know to kickstart your Monday. Stay tuned. More Asking for a Trend on the other side. Time now for what to watch next week. Starting off on the economy, U.S. retail sales data for May is coming out on Tuesday. Economists forecasting that number to tick up 0.3%. This coming after Americans unexpectedly paused their spending in April, giving us some more insight on consumers as they continue to battle inflation. And moving on to earnings, home builders in focus as we get reporting from Lennar and KB Home. Lennar announcing second quarter results next week. Analysts expecting the company's net new home sales to increase by about 18%. And taking a look at Boeing, outgoing CEO Dave Calhoun is testifying in front of a Senate subcommittee on Tuesday. And finally, Yahoo Finance will be on the ground at Cannes, bringing you coverage all next week. We've got some big interviews lined up, including conversations with executives at Mattel and Pinterest. That is a wrap on today's Asking for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great weekend.